Hello, good morning, good afternoon. This is the panel P. I'm Haizhou Huang from CICC. Our panel, have 5 head of central banks, including Governor Shamsiah from Bank Negara, Malaysia, Governor Kganyago from South Africa Reserve Bank, Governor Kuroda from Bank of Japan, Mr. Ravi, Menon, Managing Director from MAS in Singapore, and last but not least, Mr. Eddie Yue, Chief Executive of Hong Kong MA. I think that this is, of course, is one of the panels. I think that we're fortunate to have 5 central bank governors to participate in this important session. And the title for our session is How Can Central Banks, Supervisors, and Regulators help to mobilize and coordinate with other actors, that's including the Treasury, private sector, and other players in the fight against climate change. The 5 panelists have a lot of experience working in many areas, including in the IMF, Asian Development Bank, and in other areas. So I think that in order to get started properly, I will introduce each speaker when I call the speaker to talk. I suggest that we ask Governor Shamsiah to speak first, then basically to be followed by Governor Kganyago from South Africa, and to be followed by Governor Kuroda-san from Bank of Japan, and to be followed by MAS Managing Director Mr. Menon, and last but not least, Mr. Yue from HKMA. Now, let's welcome Governor Shamsiah from Malaysia Central Bank. Governor, the floor is yours.
Good morning and good afternoon, Mr. Huang and panelists. I am pleased to be in this panel. If there is anything history, or more recently, the pandemic has taught us, is that in the face of existential threats, a collective and well-coordinated response is crucial. Central banks and regulators are uniquely placed to mobilize and coordinate climate action with other actors. Given the central role of the financial system in any economy, central banks and regulators have significant influence and a direct interest in actions by financial institutions to manage climate-related risks. The policy and supervisory steer that central banks and financial regulators provide have important consequences by progress by economic agents in strengthening climate risk mitigation and adaptation. Furthermore, as advisors to the government on economic and financial policies, central banks and regulators often play a key role in helping governments navigate an orderly transition to a low-carbon economy. I'd like to focus my remarks today on how we are working with the industry and other financial regulators to respond to the climate challenge. In Negara, Malaysia, and the Securities Commission, we have established what we call the Joint Committee on Climate Change, or JC3 in short, with the financial industry to promote alignment on climate actions across multiple stakeholders. Through JC3, financial regulators are working together with the stock exchange, financial institutions, institutional investors, NGOs, and the government. We started the JC3 with a very narrow focus, acting as a network for sharing of experiences and coordinating actions. But within 2 years of its establishment, the JC3 has evolved to become a focal point for collective climate actions within the financial sector. Correspondingly, it has expanded beyond networking and coordination to providing content, stewardship, and advocacy. With financial regulators working alongside each other, the outreach of actions extend throughout the key components within the financial sector. The increasing breadth and depth of the work undertaken by its 4 subcommittees have supported a number of key initiatives to advance climate risk management and climate-related disclosure. And this includes the issuance of the climate change and principle-based taxonomy that was piloted by selected JC3 members and phased adoption of the TCFD. The JC3 is also taking on an increasing important role in developing practical tools and solutions for financial institutions and to address barriers to green financing and investments. For example, the bank is working with the industry via the JC3 platform to develop guidance documents on climate risk management and scenario analysis. This guide underscore the need to manage climate-related risks as a financial risk within the broader enterprise risk management framework, while addressing the unique characteristics of climate risk, such as its long-term horizon and non-linear features. Also, since 2017, Islamic financial institutions have also taken a leadership role in spearheading sustainable finance through the development of sectoral and activity impact-based risk management framework. Sectoral guides focusing on palm oil, renewable energy, and energy efficiency activities have also been issued and will be followed by guides for the manufacturing, construction, and infrastructure, as well as the oil and gas sectors by the end of this year. So through JC3, these complementary developments are being coordinated and integrated to build a credible foundation for the financial industry to support the transition efforts. Beyond the financial sector, the JC3 also actively engages with various stakeholders on climate and transition initiatives. The formation of a new subcommittee this year to address data gaps for climate risk analysis is another collaboration as part of JC3's effort to strengthen climate risk management and scale up green finance. The JC3 is also pursuing broader engagements with key businesses to better understand transitioning issues and opportunities along the supply value chain. This will help inform structuring of customized financial solutions for the different types of players within the entire value chain. As a financial regulator and supervisor, it is important to be clear on the objectives and motivations for our collaborative efforts with the industry and other stakeholders. The primary goal for us is to support the appropriate consideration of climate risk in promoting resilient financial institutions. With this goal in sight, first, we need to recognize that climate risk is a cross-cutting risk for which risk management approaches and methodologies are largely still underdeveloped. Given this, there is much more to be discovered in terms of how it can be managed in an integrated manner with other financial risks. This suggests a need for an iterative process that will enable financial regulators and the industry to converge on supervisory expectations and a common framework for assessing physical and transition risk. As part of this process, we are examining the scope and specific approaches to incorporate climate-related risks within the Pillar 2 requirements. Secondly, the nature of climate-related risk calls for central banks and regulators to collaborate at the national level to support alignment of financial industry responses with national climate strategies and priorities. As I mentioned at the start of my remarks, central banks and financial regulators provide an important bridge between the financial sector and the government to inform national policies, targets and strategies on the one hand, and financial sector responses to climate risk on the other hand. So in Malaysia, JC3 serves as a focal point for engagements with the Malaysian Climate Change Action Council on national climate policy. Third, effective coordination with the industry serves to maximize transition benefits and minimize downside risks. For developing and emerging economies in particular, an inclusive strategy is key to avoid macroeconomic and social dislocations as we transition to a low-carbon economy. As financial and economic advisors to the government, we are also working with the government to develop sustainable finance roadmaps that will mitigate risk of stranded assets if this orderly transition occurs. The bank's principle-based taxonomy was developed with this in mind. The taxonomy aims to facilitate the direction of financial flows to activities that support the transition to a low-carbon economy and climate-resilient economy. It supports businesses in transition by recognizing climate risk mitigation and adaptation efforts over time, while preserving the rigor of assessments by avoiding greenwashing. The taxonomy also encourages financial institutions to nurture and nudge businesses to transition to greener practices. It helps improve development outcomes and builds capacity within businesses themselves to better manage climate-related risks. To further support transition activities, the bank has also established funds to assist SMEs in pivoting their businesses to be more sustainable in a post-pandemic world. This includes transitioning to greener activities. The bank is also looking to further expand these facilities with a greater focus on green activities that are aligned with the taxonomy going forward. The bank also sees great value in pursuing a coordinated and regionally coherent financial sector response to the climate challenge. So within ASEAN, the bank is working closely with central banks in the region through the ASEAN Taxonomy Board in the construction of a regional taxonomy that can provide a common language for sustainable finance in ASEAN and also promote efficiency. This will encourage the alignment of national taxonomies, building on common principles and a tiering system to cater to differences in financial systems, economic and social structures, and transition paths. Let me close with a final point on global coordination. As countries embark on a different national transitional path at varying paces, a global challenge is the disproportionate impact on emerging economies. This makes it more difficult for them to control their own transition path due to the economic and financial linkages. This reality calls for a more coherent global coordination to galvanize collective actions with stronger link to the NDCs under the Paris Agreement that will help improve climate equity and mitigate risks of disorderly transition. This would compel countries that generate transition spillovers to provide financing, technology, and capacity building support to assist smaller and developing countries to adapt to climate change and take mitigating actions. This, in our view, is a step towards a more equitable and effective global mechanism to respond to climate risk at a faster pace. So let me end my remarks here. Thank you.
Thank you, Governor Shamsiah. I think that let's move on to the next panelist, Governor Kganyago. I think that as we agreed, and for the first round, each panelist will speak for 8 to 10 minutes, no more than 10 minutes. Governor Kganyago, the floor is yours.
Thank you very much, Chair. I'll be briefer than that. I think that as central banks, supervisors, and regulators, we already have established coordination mechanisms with government and with private institutions. We should leverage those on now to develop policy interventions to increase the resilience of the financial system and support the climate transitions. Of course, where the structures do not exist, we've got to be setting joint structures in response to recommendations from various institutions such as the Network for the Greening of the Financial System and the Bank for International Settlements. But then setting these forums and coordinating structures or utilizing them where they exist, there are important guidelines that we have got to take into account as central banks to ensure effective coordination with other institutions. Let me start with this caution that we've got to avoid mission creep. Taking over the policy space of government departments can reduce central bank accountability, reduce policy independence, and overburden central banks' existing mandates. Negative impacts include stranded green assets and a decrease in productivity as industrial and tax incentives and central banks' balance sheet policies lead to overinvestment, for example. But central banks should be activists in climate change space, but within our remit. Most times, the first best policy tool to deal with climate change falls under the remit of the government and not so much of central banks. Secondly, is that we have got to adhere to the core mandate and best practices in macro policy coordination. Central banks should adhere to their core mandates as a tool to facilitate effective policy coordination, but also as a tool to attract green funding. Many emerging and developing economies are savings constrained. As a result, and only available macro policy options to attract funding is maintaining macroeconomic stability. Thus, using fiscal space well and enabling clear pricing of positive and negative climate change externalities by maintaining low and stable inflation. Thirdly, central banks can provide analytical capacity and data. Central banks have an important role to play in providing analytical capacity to government, and efforts by central banks to better comprehend the economic implications of climate change should inform the conduct of monetary policy, general policy formulation in government, and the decisions of market participants, notably investors and financial institutions. This contributes to better coordination and mobilization. Fourth is the issue of communication of the climate risks. Central banks have recently been using communication almost as a policy tool. We have got standing in society that when a central bank speaks, society takes notice that the central bank is speaking. And we've got to be able to use communication as a tool to highlight the risk of climate change and support greater mobilization of actors and resources. This brings me to my last point, which has to with international coordination and mobilization, which is equally important but difficult. The global financial crisis and COVID-19 crisis show that we can coordinate effectively in some areas, but not in all. In many ways, COVID-19 is similar to climate change. The mitigation efforts of one country or a small group of countries is not sufficient to address climate change. Just as vaccinating the population of some countries, but not all, is unlikely to resolve the COVID-19 crisis. We need to build on lessons from the COVID crisis and improve coordination. But coordination and mobilization on international level is hard due to asymmetries in country size, disagreement about the policy situation and cross-border impact, and limited recognition of trade-offs, as pointed out by Jonathan Ostry and Atish Ghosh in their paper. We need to overcome these obstacles. Again, current institutions, IMF, BIS, and new institutions as NGFS are well positioned to lead and drive efforts for a coordinated response to tackle climate change. These include, for example, efforts to improve disclosure requirements and develop global green taxonomy guidelines. Analytical work is being developed and rapidly to inform policy and develop coordinated responses. Let me just conclude by saying that central banks can improve policy coordination, for example, by supporting international consistency in climate-based taxonomies and by producing technical analysis to guide the design and assessment of these taxonomies. This supports policy coordination at the local and at a global level. Let me stop there and return to you, Chair.
Thank you so much, Governor Kganyago. I think that let's move to the next speaker, Kuroda from Bank of Japan. The floor is yours.
Thank you. It is, of course, my great pleasure to take part in the Green Swan conference, joined by distinguished participants. Climate change poses a significant risk to the economy and the financial system on a global scale. The risk needs to be addressed with a sense of urgency through an internationally coordinated initiative involving both private and public sectors. Financial authorities have an important role to play in coming up with appropriate responses to climate-related financial risks, and here too, close coordination among financial institutions, financial authorities, the public sector, and academia is essential. In advancing such coordination, I would like to offer three perspectives. First, it is important to form a common understanding of climate-related financial risks and their economic implications. Having such understanding is a prerequisite for good coordination. To this end, the Bank of Japan this March hosted an international research workshop on interactions of climate change and the financial system. A wide range of participants from public and private sectors, as well as academia, had a lively discussion on a range of topics, such as improving data quality, measuring climate-related financial risks, and applying analytical results to the climate policy framework. The workshop served as an excellent opportunity for participants to not only share their views and experiences, but also work toward forming common ground on climate-related financial risks. Second, we central banks need to be flexible in designing appropriate policy responses toward net zero society, as pathways to net zero can be quite heterogeneous across the globe. Our coordination action need to be accommodative to regional differences. Climate-related risks that each region faces greatly vary depending on its geographical characteristics and industrial structure. For example, Asia is a region perhaps most exposed to significant physical risks such as floods and drought. It accounts for almost half of the global emissions as the global industrial production center. Africa may face some different issues, and Governor Kganyago might want to say a few words later. Related, transition costs would naturally differ across regions. For each region, it is necessary to consider appropriate division of cost allocation between the public sector and the private sector. As such, our policy responses should avoid a one-size-fits-all in nature. Lack of due consideration to heterogeneity, policy responses, and standardization would do more harm than good. Policy responses with an appropriate balance of harmonization and heterogeneous consideration would strengthen introduction of climate-related financial instruments, standardization of trading practices, and risk assessment methodologies. It could also contribute to the reduction of greenwashing and carbon leakage. Third, coordination among relevant institutions is a key to have effective solutions toward net zero society, taking due considerations of their mandates. Naturally, governments play a central role in climate change policy by setting a course toward reducing greenhouse gas emissions, and central banks can support this transition. For example, central banks can play an important role in strengthening engagement with financial institutions and measuring climate-related financial risks to foster financial stability. Any central bank policy actions on climate would need to be carefully assessed with due consideration to the mandates stipulated in the legislative document of each central bank. Climate-related issues have gained massive traction in many international forums. As in its recent press release by the UK G7 presidency, G7 finance ministers and central bank governors have been discussing on how to address them collectively. The G20 too places them as a high priority agenda. The Basel Committee and the Financial Stability Board are advancing their deliberations on climate-related financial risks, and the NGFS is making contributions on various fronts, including climate change scenarios. The Bank of Japan is making active contributions in international discussions and in tandem, collaborating with domestic authorities on how best to play its role consistent with Japan's commitment. The Bank of Japan will continue to explore actions and take necessary steps on climate. Let me stop here.
Thank you so much, Mr. Kuroda-san. And I think that let's move on to the next speaker from MAS in Singapore, Ms. Menon. Ms. Menon, the floor is yours.
Thank you. Let me first thank the BIS, Banque de France, the IMF, and the NGFS for organizing this event. This is a great initiative to help focus the minds of those of us in the financial sector on the actions we need to take to address the risks from climate change and to make the financial sector an engine for green and sustainable economic growth. The financial sector plays a critical role in the fight against climate change. Let me highlight three key areas where central banks and regulators can work together with the industry and mobilize action to promote sustainability. And I'll take some reference to MAS's efforts in these areas to illustrate the points. Three areas: build capabilities in climate risk management, to strengthen corporate disclosure practices, and three, to support transition needs. Let me start with building capabilities in climate risk management and monitoring. First, central banks and financial supervisors need to build up our own capacity to assess climate risk management. We need to incorporate climate and environmental risks within our supervisory frameworks. So MAS is leading a work stream on micro-prudential supervision under the Network for Greening the Financial System, NGFS, which provides guidance for supervisors on how to incorporate environmental risk management in their supervisory frameworks. This guidance is being updated, and capacity building efforts are being planned for supervisors to share best practices with one another. We need to make available training resources for financial supervisors on climate risk management. In this regard, MAS is very pleased to support the efforts of the Climate Training Alliance, a dedicated portal for training on climate risks for central banks and supervisors, which is established by leading international organizations such as COP26, the BIS, NGFS, IAIS, and the SIF. Next, we need to better understand how climate risks can potentially impact economies and financial systems. This means mapping the risk transmission, identifying the relevant metrics, and bridging the data gaps. NGFS is doing very good work in this area, and MAS is leading an effort under the NGFS to study potential financial risk differentials between green and other assets, and also reviewing methodologies for climate and environmental risk analysis. Second, financial supervisors must help set the pace for capacity building and facilitate the sharing of best practices. Many FIs are still in the early stage of implementing climate risk management guidelines practices. MAS has worked with the financial industry to co-create guidelines on environmental risk management, covering banks, insurance companies, and asset managers. And they set a common baseline on identifying, assessing, managing, and disclosing environmental risks, while customizing the supervisory expectations according to the business models of the three sectors. We then convened a private sector-led green finance industry task force, which has then issued an implementation handbook, which offers guidance on best practices in environmental risk management. And we thought this method of working with the industry and the regulator co-creating these best practices is a good way to go forward. A third, climate stress testing. This is a critical capability that central banks and regulators need to build up together. MAS intends to incorporate a broad range of climate risks in our stress test for the financial industry by the end of 2022. Now, undertaking this will help increase industry awareness of the economic and financial implications of climate risk. It will also provide a very strong incentive for financial institutions to progressively build their capabilities. Capabilities such as reconfiguring the conventional stress testing models to include sectors vulnerable to climate risk, developing counterparty level climate risk assessment methodologies. And this is something we're working very closely with the financial institutions. So that's about climate risk management. The next key area for action is strengthening climate-related disclosure practices. We need robust and comparable climate disclosures by financial institutions, their customers, and their investee companies. This is critical for effective risk management, market discipline, and effective deployment of funds towards financing green and transition activities. But access to robust, comparable, and high-quality ESG data is a big problem. And this is a huge challenge impeding the growth of sustainable finance globally. It is really vital to strengthen the disclosure practices of financial institutions and listed issuers. Here, I'm deeply encouraged by the accelerated pace of efforts by IOSCO and the IFRS Foundation towards setting global sustainability reporting standards. The IFRS Foundation is looking to set up an international sustainability standards board to be a single global standard setter, and this is in track for November this year. MAS is strongly supporting this initiative. We're actually participating in the process, the IOSCO Sustainable Finance Task Force, and in particular, we are co-leading with the US Securities Exchange Commission, a technical expert group, to assess the technical recommendations by an IFRS working group on whether a prototype climate reporting standard can be a sound basis for future standards development once they're established. And this builds on the very well-regarded TCFD recommendations. Financial institutions and listed issuers must start leveling up their climate reporting practices. They must start doing it now. The TCFD recommendations provide a good baseline framework to start. MAS expects all our financial institutions to make disclosures in accordance with well-regarded international reporting frameworks, such as the TCFD recommendations. And the Singapore Exchange has also announced plans to incorporate TCFD recommendations in its sustainability reporting guide to assist listed issuers on their climate-related disclosures. Finally, supporting transition needs. Unlocking transition finance is critical to achieving the Paris Agreement goal of keeping global average temperature rise to 1.5 degrees Celsius above pre-industry levels. The need for transition financing is especially strong in Asia, which accounts for almost half of the global greenhouse gas emissions. Many countries in Asia are undergoing rapid economic development and urbanization. They need a progressive pathway to move away from fossil fuel-driven energy. And we need significant financing to cut down these emissions and improve overall ESG performance. The significance of supporting inclusive transition cannot be overlooked. We need to be practical and thoughtful. What we need to aim is to bring about progressive sustainability improvements across entire economies in Asia, rather than in just financing some pockets of green sectors that will not change, that will not move the needle. Here I would say two key areas to collaborate on to enable transition finance: taxonomies and blended finance. We need a common language on what economic activities can be considered green and transition, so that financing can flow at scale to support the journey to a low carbon future. And we are developing a taxonomy catered to the Asian context, building on the well-regarded EU standard. And the additional dimension in this taxonomy is the focus on identifying transition activities to facilitate financing activities that are not yet green, but are working towards carbon neutrality. And we're also working, as Governor Shamsiah has mentioned, with our ASEAN counterparts, including the Bank Negara Malaysia, to develop a consistent regional ASEAN taxonomy that will take into account both international goals and standards while being tailored to regional context. Finally, blended finance. We need to deploy public sector financing to crowd in private capital to finance the transition needs of Asia. And blended finance can play a key role. There are many risks: counterparty credit risk, geopolitical risks, risks associated with emerging and nascent green technologies that make many green projects not bankable. So we need the public sector to come in to provide a base level of financing and risk coverage, so as to crowd in private funding from financial institutions, multilateral development banks, philanthropic foundations, international organizations to support green and transition projects. To conclude, the transformation of global economies to a low-carbon path is perhaps the biggest economic transition in several centuries. And finance must be at the heart of supporting this transition through the central role it plays in managing and pricing risk and supporting investments. And we cannot do this alone. And apart from coordinating with ecosystem actors at the domestic level, we need continued strong collaboration at regional and global level to effect this worthy transformation. Thank you. I'll stop here.
Thank you, Ms. Menon. I think you made many interesting points, especially on the role of private sector or the interactions between central banking community and the private sector. Let's move to the last speaker for the first round. Last but not least, Mr. Eddie Yue, Chief Executive from HKMA. Mr. Yue, floor is yours.
Thank you very much, Haizhou. And I'm very pleased to be in this very timely and also useful conference. Like others, I also thought that climate change is probably the most serious long-term challenge that's faced by the world today. And global efforts are definitely needed to combat climate change. And these efforts will also bring about new opportunities in finance. And this is where central banks will come in. And in my view, central banks and financial regulators can play two critical roles in combating climate change. One is to guide the financial sector to manage climate risk. And second is to scale up the green financing market to support the economy's decarbonization together with other stakeholders. In terms of the specific initiative, and based on our own experience in Hong Kong, I will group them broadly into three areas. The first is the need to set clear rules for the financial industry. And the focus of these rules are obviously risk management and disclosure, both to ensure the resilience of the financial system and also to inject more transparency so as to facilitate more informed capital allocation and also market discipline. For example, here in Hong Kong, the HKMA has been working with the industry to build climate resilience into the banking system. We completed the first greenness assessment on banks last year. And using the outcome of that assessment, we are now formulating supervisory requirements on climate risk management. And in parallel, we have also launched a pilot stress test pilot exercise on climate risk stress testing to assess the climate resilience of the banking sector and also to facilitate the capability building of participating banks, very much in the same vein that Ravi has been mentioning just now. And also financial regulators in Hong Kong together have also committed to mandatory climate-related disclosure in line with the TCFD recommendations across different financial sectors no later than 2025. The second area is the need to build the necessary infrastructure and catalysts. The purpose is to provide the industry with the right incentive and also the capability to go green. While the specifics will differ across different jurisdictions, but there are three general difficulties that we see the industry facing when they try to scale up their green finance activities: talent, data, and cost. And we are trying to work with both the government and also the private sector to address all these three issues. For example, we launched the Alliance for Green Commercial Banks with the International Finance Corporation last year. This is a global scheme that encourages commercial banks to adopt greener practices. And the HKMA will jointly launch initiatives and campaigns with IFC to support financial institutions on their green transition. And this will include things like training workshops or the issuance of practical guidelines. The HKMA is also joining hands with the other regulators, academia, and the private sector in Hong Kong to set up what we call a joint green knowledge center, which will become the go-to place for financial institutions to access common data pools, to adopt new data models, and simply to find some learning materials in green finance. And one practical barrier for some of the smaller firms to go greener is the extra cost for green reviews when they issue bonds or when they borrow loans. And we thought that a positive nudge, a small nudge, can be given by the government to ease these cost concerns. And in Hong Kong, the HKMA is supporting the government to roll out and enhance green and sustainable finance grant schemes, which provide subsidies to offset the additional costs in going green when firms issue bonds or when they borrow. And lastly, with the rules, infrastructure, and also catalysts in place, the third area that we need is to promote awareness and market participation. For sustainable finance to thrive, both the suppliers of capital, including the asset managers, the banks, pension funds, and ultimately the public, and also the users of capital, basically the corporate sector, they all have to be on board the sustainability agenda. And in order to encourage the industry buy-in, we at the HKMA have been leading by example by weaving ESG factors into the investment process of our own foreign reserve. For example, we've been an early investor in green bonds some 6 years ago and have since adopted the guiding principle that we will give priority to green investments if the long-term return is comparable to other investments on a risk-adjusted basis. And we will also be expanding our ESG equities portfolio through investment partners that can also help contribute to the Hong Kong green finance ecosystem. The government is also helping. They have launched a huge government bond program, a green bond program, to create demonstrative effect for the market. A total of $3.5 billion worth of green bonds have already been issued so far. And all these proceeds are allocated to green public works in Hong Kong, including waste management or green buildings. The government plans to double the borrowing ceiling of this program to roughly $26 billion to allow for even more green bond issuance. And we're also planning to issue a retail green bond to encourage public participation in the greening of Hong Kong, and through that process, raise the public awareness of the need to go green. And these are just some examples of the initiative that we are taking together with the government and the private sector locally. But like others said, sustainable finance has to be cross-cutting and global in nature. And I believe that coordination among policymakers from different jurisdictions will be essential. And HKMA is very ready to contribute our experience and coordinate efforts with our peers globally through the various forums that the other speakers have already mentioned. And I thought the conference today is an excellent example of the type of international collaboration that's needed to scale up the climate action needed. Thank you very much, Haizhou.
Thank you, Mr. Yue. I think that concludes the first round of speaking. I think that all 5 panelists gave great speech on, from some different perspectives. I think that let's move to the second round in a way. This is interactions among the panelists, and also I start to receive some questions from the audience. So I guess that of course you are welcome to ask each other's questions. But before you doing that, I think that I would like some simple questions to warm you up. Perhaps in the reverse order. So I would ask Mr. Yue first, and then in that order, then maybe we'll leave you time for asking you questions to each other. And towards the end, I think that I already collect some questions. I will ask you some questions on behalf of the audience. So for Mr. Yue, I think that Hong Kong, of course, is a very important international financial center. You already mentioned that HKMA already invest in green bond, and very early on. And given that the HKMA manage a very sizable reserve for the Hong Kong government, how much more could HKMA do, or other central banks could do? Of course, Bank of Japan manage far bigger reserves. So maybe that's also a question for Kuroda-san. But Mr. Yue first.
Well, I think there's a lot more that we can do. For example, I talk about us getting into the green bond market some 6 years ago. But the market also has to develop in the right pace to fit the appetite that investors increasingly have on these green products. For example, 5-6 years ago, when we first entered the green bond market, we actually find problem in verifying which bond is green or which bond is not. There are no set standards. There are no established green reviewers there. We engage different rating advisors, and the advice that we get on the same corporate can be very different. So there is this lack of infrastructure in market that will allow investors like reserve or sovereign wealth funds or institutional investors to go bigger in green bonds. Same with equities. If you look at the why we are only starting our equities, ESG equities investments just 2 years ago, it was because of the lack of the right ESG index, and they don't have enough track record for us to benchmark upon. So, but I'll have to say that in the last 1 or 2 years, the momentum in building this infrastructure has been tremendous. So we're actually now seeing a lot more reviewers coming in. But of course, what we need is like what we discussed before, common taxonomy, common disclosure standards, reporting standards. These are essential facts or data that are needed for the reviewers to do a good job. And also the ESG indexes are also maturing. And that's why we can also expand our equity portfolio towards more green or ESG investments. In fact, our experience in the last 2 years is that our ESG portfolios are outperforming our traditional portfolios because in the last 2 years, it was a very special 2 years. For companies that actually have good governance, respect the environmental rules, they fare better in the last 2 years. So we will be continuing with our efforts using our role as an investor to push the greening of the financial system, and also as the central bank to push for even more common standards globally to be established in order that the infrastructure can support the increasing appetite of the investors. Thank you.
Thank you, Mr. Yue. I think that maybe let me ask this question to Kuroda-san from Bank of Japan. Of course, again, first part of the question is that Bank of Japan manages a huge amount of reserves, and to what extent do you think that green finance, or green bond could be invested by central banks? And secondly, I think that Bank of Japan also is a very active market maker for the ETF market in Japan. So perhaps in the future, Japan could develop a very sizable, maybe a leading ETF market on green finance, and maybe you could shed some light on that. Related to that, of course, you serve as the president of Asian Development Bank. Maybe you could shed some light on how central banks could coordinate better with the international financial institutions. Kuroda-san.
Thank you for raising very interesting issues. First, I'd like to explain the fact that the Bank of Japan, unlike many Asian and European central banks, Bank of Japan does not manage foreign exchange reserves, or does not manage pension fund, or does not manage sovereign wealth fund. So the amount of asset we have accumulated is a result of our monetary policy itself. In the last several years, certainly, the Bank of Japan has acquired large amount of JGBs, as well as you said, ETFs and so on and so forth. But these are the result of our monetary policy decisions. And I think unlike managing reserves or pension fund or sovereign wealth fund, monetary policy responses must be formulated considering various factors, such as how not to distort resource allocation. So, of course, the Bank of Japan will continue to proactively contribute to international discussions in the form of conferences, bilateral and multilateral meetings with relevant authorities and other stakeholders, which will certainly deepen understanding. And as you can imagine, among G7 countries, central banks do frequently discuss various issues, including what kind of contributions the central banks can do in relation with climate change issue. Now, you mentioned the fact that the Bank of Japan has acquired very significant amount of ETFs. That is true. However, in terms of the ratio of our shareholding through ETF within the total Tokyo Stock Exchange value, it is still around 7%. It's not so huge, but of course, in the last several years, the Bank of Japan utilized this instrument to stabilize and also to reduce risk premium in the stock market. For instance, March last year, when the stock market, not just in Japan, but also globally, became so destabilized, the Bank of Japan acquired large amount of ETFs from the market. By so doing, quickly stabilized the stock market. So this is one of the instrument of monetary policy. So as such, I still think that we have to respect our central bank mandate, basically to achieve price stability and financial sector stability. And in relation with climate risk management, as I said at the outset, we can do many things in collaboration with the FSA, the financial regulators, and also with financial institutions themselves. And here I can assure you that the Bank of Japan would continue to make utmost efforts. Finally, on Asia, yes, I was president of the Asian Development Bank from 2005 through 2013, or 8 years. And during my presidency, actually the ADB issued the green bond and also increased very much the support for climate change mitigation and adaptation effort among developing member countries of ADB. As many mentioned, Asia emits more CO2s, more greenhouse gases than any other region, accounting for nearly half of global emissions. And also, Asia is most vulnerable to climate risks, such as flood, landslide, and drought. And for many Pacific Island countries, rising sea levels and so on. So, on the one hand, Asia is very vulnerable, and on the other hand, Asia emits more than half of global CO2 emissions, so that Asia must make utmost effort to reduce greenhouse gas emissions. And in this area, as you suggested, not only central banks and regulators, but also government, and also, I must say, multilateral development banks like ADB and the World Bank can do lot of contribution in this area. Thank you.
Thank you, Kuroda-san. Let me ask Ms. Menon from MS two questions. One, of course, you mentioned, you said very well that the climate risk probably is the biggest risk, biggest transition for centuries, or biggest economic transition for centuries. Of course, we are facing some important systemic risk. I mean, given that the central bank or MS relate are best positioned probably to handle systemic risk, and to what extent do you think that the central banking committee should treat this issue more seriously? I know that the MS has been doing a lot, but if you could provide some general comments on behalf of the central banking committee, that would be useful. Secondly, I received a question from Central Banking Journal, Rochelle King. She asked, how do you find a balance between seeking domestic supervisory role, supervisory rules, and ensure it does not have serious repercussion on emerging market as well? So I think that that's probably, given that Singapore is a very important financial center, and the policy indeed would have impact on other emerging markets. So let me ask you two questions.
Okay, thank you, Haizhou. On the first question, what can central banks do on the international, especially at the international level? I think the focus is on risks, potential risks to financial stability. I agree with Governor Kuroda-san. I think monetary policy is not very relevant in this regard when it comes to climate change and the challenges associated with it. I think we should keep that separate. But central banks, and in many cases together with the supervisors or financial supervisors, have a responsibility for financial stability. And in MAS's case, we are both the integrated regulator and the central bank. So we have a huge responsibility for financial stability. And if climate change is going to be such a big transformation, then it is going to have a big impact on economies, which means it is going to have a big impact on the financial system, which means it is going to pose considerable risk. And I think there are two kinds of risks that central banks are worried about. One is physical risk. And Governor Kuroda-san mentioned again the various natural catastrophes that are increasing in frequency. And when these happen, it affects asset values. Assets that are damaged by climate change, by drought, by rising sea levels, and so on. So there are huge implications. Changes in weather patterns can affect the fortunes of companies. And financial sector that is either lending or investing or in providing insurance, all will take a hit. So that's one, physical risk. Now, we really don't know when these things will happen. They're happening more frequently. We don't know how serious it will be. So I think the best approach the central banks have been considering is stress testing. Basically come up with a few scenarios of serious climate damage and then ask ourselves, stress test the financial system to see how it affects us. I think the other risk is more serious, which is transition risk. When you have new technologies like renewables and increased use of transition fuels, many of the traditional fossil fuel assets or assets exposed to fossil fuels or companies that derive a lot of their revenue from fossil fuels are going to be affected. In fact, I think there are estimates that if the world is to succeed in reaching the Paris Agreement goals, a big part of fossil fuel assets today are going to become stranded. Now, if you're a bank that has lent to this or invested in this as a fund manager or asset manager, that's a serious risk. So we need to understand how these risks, whether it's a carbon tax, whether it's a technology developments and so on. These are all good things that will help us reach a more low carbon future. But the fact is, it will also mean economic restructuring and risks, and the financial system needs to be prepared. So this is central for central banks to be worried about. On Asia, what are some of the issues? I think transition is a major issue. You asked whether all that we're doing, how is it going to affect emerging economies? I think that's a very important question. And I think as several of the other panelists have mentioned, Asia is going through both economic and social development and having to reduce carbon footprint. It is not easy to do that. Many villages in many parts of Asia do not even have access to electricity, running water, sanitation. And this means investments. But they have to look for the cheap investments. And they think burning coal is a very good way to provide electricity. So we need to, of course, discourage coal, but look at transition. Maybe they can use natural gas, which is cleaner. It is not as good as renewables, but renewables are very expensive in many of these parts of Asia. So we need a transition pathway. And that's why I said earlier on, it's very easy to invest in green projects. There will always be a few pockets here and there. But how do you change the whole economy? You must do transition financing. Encourage, put pressure on the companies to adopt new and greener technologies. It is not completely green, but it is better than brown. And so you make this transition over a few years. I think that's the best way that emerging economies can continue to grow, but at the same time, reduce their carbon footprint. It's a difficult challenge, but I think we need to understand that trade-off and work very intelligently and creatively to address it. Thank you.
Thank you, Mr. Menon. Let me ask Governor Kganyago. You worked in the Treasury. I think that in Mr. Menon's comments and also in Governor Kuroda's comments, there's some reference or some on fiscal policy. And how do you see that the central bank and the Ministry of Finance or Treasury should better coordinate to deal with the climate risk? Governor Kganyago, floor is yours.
Thank you. Thanks. Well, fortunately, we already in South Africa have got joint working groups between ourselves and the Treasury to tackle the important climate risks. At the moment, we focus on implementation of disclosure requirements. We need to understand the extent of the climate challenge that we are facing and making sure that the private sector is actually disclosing the extent of the climate risks that they are facing. And secondly is the development and introduction of the green taxonomy. I think that it is much easier to talk about greening economies. What exactly is green? And Ravi earlier on was talking about telling countries move away from coal and do something green, and use the example, for example, of gas. But for a country, for example, like South Africa, which does not have big rivers, so we can't use hydro. We have an abundance of coal, and that is what we had been using throughout the years. We do have an abundance of sunlight, so we could use solar. But we have got to transition. We are a big emitter. We know we are the biggest emitter on the African continent as a country. By any measure, whether we measure as a unit of output or by the amount of greenhouse gases we emit, we are a big polluter. But for that transition to take place, the point that Ravi makes, which has to be underscored, is that there have to be the financing of the transition. Because it is no point, we are on the same planet. So if you do the transition in one part of the planet and you leave the other parts of the planet continuing to pollute, we are not going to move anywhere. You are still having the same planet. And I think that lastly, being for us, to design suitable stress testing scenarios. We understanding the sector and the risks that it is facing is one thing, but understanding what the impact of the climate risks would be on the sector, which is an important financial stability issue, becomes important. And designing those scenarios, those stress test scenarios, so that we could understand the impact not just of the individual institutions that are systemic, but understanding the impact of the sector as a whole becomes important. And of course, as treasuries come in here, they do make the calls about allocations and whether there are things that could be done in the tax system to facilitate with that transition is going to be important.
Thank you, Mr. Kganyago, for your very insightful comments. Last but not least, let me ask two questions to Governor Shamsiah. One, of course, you already mentioned that in Asean that they will, there need to be more coordination regionally on this issue, not only from the Central Banking Committee, but also at the government level and also probably at the NGO, among NGOs. Maybe if you could shed some more light on that, that would be very useful. I think that this is indeed, as Governor Kuroda mentioned, that the issue probably is more serious in Asia in a way. So that's the first part of the question. Secondly, I think that it would be nice if you could also shed some light on more light in a way. You already mentioned some of this on the interactions and the coordinations with the financial supervisors and regulators. Governor Shamsiah, the floor is yours.
Yeah. Yes, at ASEAN, we have recognized that climate risk mitigation is something that needs to be pursued in earnest. And that was why last year, the ASEAN Central Bank Governors and Finance Minister have endorsed a roadmap towards a more greener financial system and a more greener economy. And that culminated in the issuance of the ASEAN Taxonomy. And the ASEAN Taxonomy, again, is principle-based and it will have tiers because it has to take into account the different levels of development of the various countries in ASEAN. And also, the ASEAN also has set up what we call the ASEAN Taxonomy Board to also take this through and ensure the effective implementation. So that because like what other speakers have said, in order for us to really move the needle, and a common taxonomy is a very key initiative that needs to be pursued. So at ASEAN level, this is something that is being pursued not only at the governance level, but also at the ASEAN finance ministers. And so we have this green map. And your second question on financial regulator, like MAS, Negara is also a central bank and a financial regulator. And that was why the Joint Committee on Climate Change is jointly chaired by Negara Malaysia and the Securities Commission. And like what I have said, we found this JC3 to be an invaluable platform in order for us, initially it was more about capacity building, sharing of experiences, and now it has moved after 2 years into a path of advocacy and also the main channel for us to engage with the government because, like I said, the financial system cannot operate in isolation. It has to be in line with the national policies. So there is that iterative process that needs to take place between what the financial institutions are doing and the government. And one thing that we are contemplating, and this is where I would like to hear the views from the other panels. We often hear about, whether we should be using regulations, especially capital charges, as a means to accelerate the climate mitigation strategies by the financial institutions. And the answer that we always get is, we need more data. Data is never going to be enough. It will take us, a decade, for example, to be able to do this. So one of the things that Negara is really seriously looking into is, whether, this is something that requires some leap of faith. That, now that we have this taxonomy, even at the ASEAN level, whether we could start looking at, whether we want to use regulations to incentivize and to accelerate this credit, the risk management, and the push for more accelerated credit climate mitigation strategies.
Okay, thank you. I guess we are running out of time. We have more or less like 5 more minutes. So we don't have time for the panelists to ask each other's question. But I know that you interact fairly regularly at the BIS, IMF, or Asean, or foreign, other forums. So I think that also I understand that you are very united in fighting climate risk. So I think that I saved that trouble for you. Of course, it's a great panel, and I think that you all share great insights, very useful for me, and I learned a lot. It's very hard for me. I think it's impossible for me to summarize the key messages in a coherent way. But I think that a few messages are very important. I think that this will probably be useful for the audience. Number one, I think that you all have emphasized the importance of the issue. I think that Ms. Menon mentioned that this is probably the biggest economic transition for centuries. Mr. Yue said that this is the most serious long-term risk that the world is facing. I think that on that, I think that each of you shared a very important insight. I think that there is a general consensus in that area. Secondly, I think that you all have emphasized that coordinated teamwork is needed. This is not just about among central bank committee, but also it's about the coordination between Treasury and the central bank committee, and the coordination between central bank committee and the private sector, the financial markets, and other players in this game, of course. So I think that including NGOs, those are very, very important. I think that thirdly, you also mentioned the interactions or coordinations with regulators. I think that some of you have the mandate. I know a few of you, MAS, the Malaysia Central Bank, HKMA, and you all have the regulator rule, and so there, I think that coordination with the regulators are also needed in order to handle those risks, and those are very important. And certainly, there are a lot of more work that needs to be done. Fourth, I think that I think that we also need some practical, concrete steps for the financial sector. Several of you mentioned the role of financial sector. I think those views are reflect clearly in Mr. Yue's comments, in Mr. Menon's comments, and so I think that both Hong Kong, Singapore are very important financial centers in that regard. But of course, Tokyo is also a very important financial center, and so in a way that central bank committee can play a very leading role in working together with the private sector in the financial markets, on which I'm part of that. So certainly we would be delighted to have more interactions, more policy coordination with the central banking committee. Lastly, but not least, I think that I asked some of you those questions. I think that climate change certainly is a very important systemic risk, and the central banks are well positioned to handle this risk. So in a way, in terms of responsibility, it's certainly part of the central banking responsibility. On that, I would like to refer a very important paper by Professor Patrick Bolton from Columbia that was issued recently as a very important paper by CEPR, basically highlighting the role of central banking in handling systemic risk. Of course, climate change is indeed systemic risk. So that's a very, very important mandate for the central banking committee, and I'm sure there will be many other occasions that we will talk about those issues, exchange views. But as far as I can see, there are very strong united views, general support among the panelists. Let me thank you all for your participation and for sharing your insights. And I hope to see you around, and I hope that we will continue the discussions in other forums in the future. Thank you so much.
Thank you.
So I also know that central bankers are very precise on timing, and we can conclude the session and right on time and right on the point. Thank you so much again.
Thank you.
Bye-bye.
Bye-bye.